Welcome back. Welcome, Keith, with Peak Mortgage, one of our lending partners here at Design Realty. We're here to talk today about how interest rates affect home affordability. Welcome back.
Yeah, thanks, Joe. Thanks for having me.
Yeah, so we're going to dive in here. I got some questions, just kind of overall how mortgage rates affect affordability, what happens, especially with some of the wild swings we've been seeing lately. And for viewers, Keith has kind of put together a scenario so we can, as we go through the questions, we can kind of compare some of the, the considerations and stuff. So let's jump in. How do rates impact a buyer's monthly payment?
Yeah.
Seems obvious.
Shocking answer here. The more they go up, the less home they can afford on paper. No, yeah, it's basically one of the driving factors in our job is debt to income ratio, and there's certain percentages that we have to be within so that a consumer can technically afford a house, right? So as rates go up, that principal and interest payment's going up, and to see them basically to see it on paper, it's going to impact how much you can technically afford on paper. So
yeah, and actually, I think that's kind of a good segue into not just, a lot of people think, well, the payment's going to go up. And yes, they do, but you could also, because of the debt to income ratio, could make it so that you just don't qualify.
Exactly. Yep.
And I think around here, especially, with home affordability not really being a thing, there's no such thing as an affordable home. We have a lot of folks who are kind of on that debt to income line.
You got to push the envelope, right?
Yeah, where a half point could literally just kill it.
Yep, exactly. So
important to watch that and know where you're at.
Yeah. For example, on a $750,000 loan amount, I mean, the difference between 6.5% and 7% rate is about $250 a month. And so that can very easily affect somebody's ability to get approved for a house if they did move that much. Like you said, a lot of people around here, it's expensive to buy a house, and that's no secret. So they might need two incomes, or they might need, or they're just basically pushing the envelope as much as they can so they can buy a house. But because of that, if rates do go up between the time of pre-approval and going under contract, it can definitely we've definitely seen it impact some people negatively before. So
yeah, and I imagine as a loan officer, you probably, when you pre-approve somebody and once they get actively looking, I imagine you're kind of watching that, especially if they're looking to push their purchase.
Exactly. You try to have that upfront talk with them, try to educate them without obviously being scaring them off, right? Because it's like, hey, if rates do go up, this could impact it. They may not. They may kind of ride that channel for a lot longer, and they got nothing to worry about. But it's still a conversation that we have to have.
Definitely. And then I guess we kind of, you mentioned the $750,000 loan, the payment going up. Are there any other costs in the loan that change with rates? The only thing I was thinking off the top of my head would be like points, something like that. I don't know if that is effective.
Yeah, points just a little bit. Your daily interest charges just a little bit, but nothing really is substance that's going to impact it too much. That would persuade them one way or another from going that route.
Gotcha. And then interesting one, and we both can have some input on this. How do rates influence the home prices in the buyer versus seller's market? I guess from a real estate standpoint, talking about home prices themselves, I think, again, pretty obvious answer there that the higher the rates, the less home prices are increasing. But it's also, I think, a good opportunity to sort of make sure people understand that doesn't mean that it necessarily shifts from a buyer's market to our seller's market to a buyer's market. Because even in our most difficult rate challenge years, it was still a seller's market. It was just a little softer seller's market.
Exactly.
And so I think that I can't tell you the number of people who, started looking, they're like, I'm going to wait for rates to go down. The problem there is that then it goes from a seller's market to a hypercharged seller's market. And so every month you wait, it just, it ends up costing more and more and more in home price, which can definitely outweigh any gains in interest rates, especially now it's even stable, I think.
And a term that I use a lot is cost of waiting, right? So yeah, you might have got pre-approved and then thought to yourself, hey, let's wait till rates come down, and you're sitting on the sidelines. There's a lot of people out there that are in that same boat,
right,
have that same mentality. When in actuality, if you would have bought a house during that time, you did miss out on a little bit of appreciation. We weren't seeing the crazy record breaking appreciation that we saw back in 2020, 21, and 22. But we're still seeing it, and that's why you buy a house, is because that's where you make your money, right? Or that's one of the reasons you buy a house. So, there's a lot of people that missed out on that appreciation, and also rates haven't came down yet either.
Right.
So
they're still waiting.
Exactly. So you've just been paying a lot more money to your landlord because of that. And what I tell everybody is hey, there are, depending on the area, right, there are some deals to be had out there too. Like you can get a good deal on a house possibly, or you could get closing costs or concessions or whatever it may be. Every seller is different, but you might be able to get that The second rates go back in the 4s or 5s, if hopefully they do get there, you're not getting those deals anymore. Like you'll be multiple offer situation again. You'll be paying above ask price. You'll be back into all that stuff, unfortunately. When you could be refinancing your house into a lower rate during that time and not having anything to worry about. So
and laughing at all the buyers who are now competing.
Exactly.
Yeah, I think, Seattle typically, during the hotter years, the more typical, what is now more typical seller's market, we see, about 15% increase in value per year. So even with the higher rates, the worst years, 22 and 23, we still saw a 5% annual increase. Yep. King County's median home price is approaching $1 million. That's $50,000 a year.
It's a lot of money.
You're paying that much more. And I think for the little impact for rate when you can refinance and when it goes down, so you're only paying that higher rate for, whatever it might be, a year, 2, 3, 4 years. You're, every year, if you're losing $50,000 to $100,000, there's no comparison.
Yeah.
You just buy the house.
Exactly.
Let the market make you money and make up for the interest rate difference. Next question. We talked about this before in another episode, but really quick, just how does locking the rate work and when's the best time to do it? Are there any strategies around that?
Yeah, there's in general, we need an address to lock your interest rate. There are some special programs out there and whatnot, but talk to your loan officer about that. So yeah, once you go under contract on a house, then we're locking. There is extreme volatility that we're seeing in the market still. And so my advice to most customers is, hey, as soon as we get an address, as soon as we get a contract, let's lock it. Let's not try to play the games or anything like that.
Yeah.
Let's just get it locked and be done with it. So one less thing they got to worry about, and then they know what their payment's going to be going forward. So
that makes sense. And then these two are kind of similar questions, but which loans offer the lowest rates? And then kind of piggybacking on that, are there any strategies as far as choosing loan types or other things that buyers can do to get a lower rate?
Yeah. No, that's a fair question. So yeah, one of my favorite sayings is the wrong strategy with the lowest rate is still the wrong strategy, right? So going after the lowest rate, probably not necessarily the best thing in the customer's interest, because I could get you into an FHA mortgage with the lowest rate, but if you're putting 20% down or you got great credit, it's not going to make a lot of sense.
Right.
So but definitely talk with your loan officer about, hey, what's my best strategy? And there's a lot of online lenders out there that unfortunately advertise really low rates, but you're paying 2.5 points, which doesn't make a whole lot of sense. Your return on investment on that, it might be 10 years. But they got that hook of, hey, I have a 5.99 rate that I'm advertising, but it's going to cost you $40,000 to buy it down. Okay. So be aware of those. There's a lot of that stuff that we mainly see that online with a lot of these online lenders, just because they don't have to necessarily be here personally and don't understand how that can impact people's finances when they select the wrong strategy.
Plug you right in this, because I think one important thing too with online lenders and some of the bigger banks who are just putting these rates out there, as a broker, one thing advantage you have is when somebody gets pre-approved, you can look at their full file and figure out what the best program is.
Yep.
How many programs do you have access to? I can't even imagine.
I can't even keep them straight. Yeah. Yeah. And that's one awesome thing about being a broker is we have a lot of different good mortgage lenders out there that we work with, and they run promotions. I had a mortgage company that I sent a lot of loans to Q4 because they had a great promo. And then January 1st, that promo expired. And there was another company that came out with their own promo for Q1. And so I started sending a bunch of loans their way. So I get the ability to be able to shop around and push loans where I need to, just based off of rate and then also service and whatnot, is a huge game changer as opposed to being locked into one mortgage lender. And you're kind of subject to whatever rates they want to do. So
yeah, that's what I was gonna say. A lot of these, especially the online ones, they're a little bit more, I guess you might say, streamlined in that they're streamlined in that they don't put as much effort into the loan. They have X number of products and everybody has to fit into this couple of boxes that they have, where you just have unlimited. I mean, you can really do a lot of, offer your clients a lot of value by shopping, and you're essentially doing the shopping for them.
Yep, exactly. And at the end of the day, we want to save them money. So that's what I keep coming back to, is saving the customers money and making this process as seamless as possible for them.
Yeah. Any products, or we talked before about ARMs, 15-year, 30-year. Is there anything in different programs that really make a big difference in the rate, or are they all kind of pretty similar right now?
Yeah, I mean, like I said earlier, FHA is gonna be a little bit better, VA is gonna be a little bit better in rate than conventional, but not everyone can qualify for those, or not everybody wants to go down that road. So again, the wrong strategy with the cheapest rate is still the wrong strategy. So
I like
Get your options when you're looking at loan products. See what's available out there to you, but at the end of the day, you need to find one that kind of aligns with your short-term and long-term financial goals and how long you're gonna be in the house and all that good stuff. Not just, hey, how do I get the cheapest rate?
Our next question is, how do interest rates impact refinancing decisions for current homeowners? And I think, maybe just kind of jumping on that a little bit is, there's some scenarios where maybe a, significantly lower or not a significantly lower rate might make sense to refinance. Say somebody who's an FHA, they've paid down, they're at 80% loan to value. Their mortgage insurance won't automatically come off like a conventional. That might be a time when you might still refinance, even though the rate is not necessarily significantly better, but your payment can improve.
Exactly. Yep, exactly right. So there's lots of times where we could refinance or where we've refinanced people into very similar rates to what they had, but for one reason or another, it made sense to do that. Another big one that we're seeing now is, if you bought in the last couple of years, you did take advantage of some of that appreciation, or maybe you put down a large down payment and now you have a bunch of credit card debt or other debt that you're kind of drowning in. Going from a 6.5 to 6.5 isn't necessarily bad if you're pulling out $100,000 in equity and paying off short-term debt with that. And we use a formula called a blended rate on that, where we're actually looking at the amount of payments you're making per month and what your rates are on that, and trying to save people money that way.
Yeah, good way to pay off high interest credit cards, auto loans.
Exactly. Yeah,
that's great. Well, I think that's all we have for this episode. Thank you for joining.
Yeah, and thanks for having me.
Yeah, look forward to having you back.
Thanks, Joe.